With interest rates at the highest levels we've seen in over a decade, and the possibility of the Fed stopping rate hikes soon, a question that continuously keeps coming up is now the best time to start buying bonds? Hey guys, it's Jonathan here. And in this video, we're going to discuss the basics of bonds and what to consider if you're thinking about buying bonds now. So let's get right into it. So let's first start off with what is a bond. So a bond is basically a promissory note issued by an entity promising to pay you back according to certain terms. So basically, the way it works is that you would lend money to the entity, or the official term for them would be the issuer, and the issuer will pay you back over time according to the promissory note or the agreement that you made with them on how you would get paid back. And typically, you get paid back with interest, which is what makes these investments attractive. And the length of the payback period can vary. Usually, it's longer than 5 years, but no longer than 30 years. And it's very similar to an IOU. So, for example, let's say you want to lend the U.S. government $1,000. So you would buy one bond, which usually the par value of a bond is $1,000, and a part of that agreement will come with, okay, we're gonna give you, we're gonna pay you back in 10 years, and we're gonna pay you 3.5% interest every year, based off of the $1,000 that you lent to us, and then in 10 years we'll return your principal. So there's three different types of bonds. There's government bonds, which could be either U.S. federal government bonds or government bonds of other nations. Generally speaking, the United States, this is usually has the lowest yields out of all three of different types of bonds there are. The second kind of bond there is municipal bonds. So municipal bonds is pretty much money that you lend to either state or local governments. So think the state that you live in, or the county you live in, or the city you live in, or like the school district, or water supplier, or the utility supplier. That would be a municipal bond. Now, these bonds usually have a higher yield than U.S. government bonds, but like with most investments, the higher the reward, the higher the risk. And there is risk with municipal bonds just because municipalities can go bankrupt. I mean, think about it like this. The federal government has the money printer, essentially. So the government can just always go print more money and pay back your loan. But municipalities don't have a money printer, so they can't go and just print money. They have to actually like get the money from somewhere. And because of that, that makes them a lot bigger bankruptcy risks. And because they're more of a bankruptcy risk, the yields are higher. Now, with their yields, and this is one of the more attractive things about municipal bonds, is that their interest can be, in some cases, tax-free on both the state and federal level. That is something that you should consider if you are looking to buy municipal bonds. So the third type of bond there is corporate bonds. And these are bonds that are issued by corporations. So it could pretty much be really any publicly traded company. So think Apple, Tesla, Google, and so on. So corporate bonds usually have the highest yield of the three different bonds. And that's just because there's a much higher risk of bankruptcy. I mean, think about it like this. If Apple puts out a really bad iPhone, then people aren't going to buy it. And if they do it too many times, they will eventually go bankrupt. Whereas if the government gives you a crappy product, they're still going to get paid no matter what happens because you have to pay your taxes. So that's some of the reason why you see higher yields when it comes to corporate bonds. And generally with bonds, the big risk is that comes from the liquidity of the person who's issuing the bond. Like I said, the higher the risk, the higher the reward. U.S. government debt generally has the least amount of risk. Short-term U.S. government bonds are deemed as being risk-free, even though technically there is no such thing as a risk-free investment. Technically, U.S. government bonds are considered that, so there's that. And then obviously the most dangerous is corporate debt. So when it comes to buying bonds, there's three main strategies. I'm only going to talk about two in this video because honestly, I think the third one is kind of stupid. The third one that I'm not going to talk about is called the barbell bond strategy. If you want to go look it up, feel free. I personally don't really see a benefit of it at all, so I'm just going to skip over it. So the first main one that we're going to talk about is the bullet strategy. And pretty much the best way to think about this is that you use a bullet to hit a target, right? Pretty much the way this works is that you periodically buy bonds with the same maturity date. So let's say you have something that you're planning out 10 years from now. So you would buy a 10-year bond. And then let's say 3 years later, you buy a 7-year bond that will mature on the same day as a 10-year bond, and so on and so on. And basically, by you doing this, you're reducing the risk of the interest rate changing between the time you started buying bonds and the target date that you need the money to pay for whatever you need to pay for. So almost think about it like dollar cost averaging, but you're doing it with bonds, and instead of you averaging out your cost, you're really averaging out the yield. So you could call it yield cost averaging. Like I said, these are a good option if you do have a specific date in the future where you're going to need all of the money. So the second strategy you can use is called a ladder strategy. The best way to think about this is that ladders typically have rungs on them, and you could think about each rung of a ladder as being a bond that has its own maturity date. So pretty much you would buy bonds with different maturity dates, and the way it works is that the bonds with the earliest maturity date will eventually mature, and then you use that to buy the longest term bond in the ladder. And then the other bonds will mature, and you just continue to keep rotating it out. This is a really good way to go if you are looking to milk income from your bonds and you want to have some access to your funds on a short-term basis. So now let's talk about how you can actually go about buying bonds. And I want to state this, that even though I am a financial advisor, I am not your financial advisor. Even though this may be financial advice, it's not personal financial advice because I don't know your situation or your personality or anything like that. So I highly encourage you to reach out to a financial advisor if you have questions on this. So there's a couple ways you could go about doing this. So you can buy the actual bonds themselves. You would buy them from directly from the issuer. So, like, for example, if you're going to buy U.S. government treasuries, you buy that from the U.S. Treasury. I believe they have a website called directtreasury.com. From what I'll be honest, I've never personally bought bonds before from treasurydirect.com, but I have heard that it's very clunky. So it is something that you may want to do some research and maybe even ask some people who have some expertise in this if you are considering going this route. And when you buy actual bonds, you could kind of use either strategy, really. This is probably like the most old school way to do it. Something that's a little bit more new school is by buying bond ETFs. There's a lot of ETFs that will track total bond markets. They're like the U.S. bond market, or like an international bond market, or the European bond market, and stuff like that. And there's even some ETFs that will actually track a target date and a market. So they might track like the U.S. Treasury 1 to 3 year bond index or something like that. You can use this for the ladder strategy, and pretty much the way it would work is that you just buy. So let's say you have $100,000 and you want to buy treasuries up to the 10-year treasury. So let's say you wanted to buy the 2-year treasury, the 5-year treasury, the 7-year treasury, and then the 10-year treasury. Basically, what you could do is you could find an ETF that covers all of those different maturity dates, and you just split up your money into $25,000 piles, and you'd buy each of those ETFs and just hold it. This is really nice because you don't have to sell and rebuy. And you have to remember, even with bonds, when you sell and rebuy, there may be some tax implications there. So this is kind of a nice way for you to avoid that. Technically, you could use the bullet strategy using ETFs, but it's very complicated, and it doesn't really make any sense logically. So because you have to both time your buy and your sell. So I wouldn't necessarily, if you did want to go the bullet route, this probably wouldn't be the best option. When it comes to ETFs, they usually come with a expense ratio that eats into your profits. And this is very similar to other ETFs, even ETFs that passively track like the S&P 500 and stuff like that. They have the same expense ratios as well. So that's something to consider. And then another thing to consider as well is that sometimes with these ETFs, there will be a slight premium that you'll pay compared to the actual bond itself. So again, something else that you should keep in mind. So now the other way that you could buy bonds, and this is a way that technically you're not really buying bonds, but you technically are still getting the same benefit, and that is through CDs. And this is by far the easiest way for you to buy bonds. You can use either the bullet or the ladder strategy for this. And the best way to do it is on an online bank that has very high yields on their CD. So this video isn't sponsored by this company, but I will say that a good example of this could be like Ally Bank. Now, you will pay a premium going this route as well. So for example, Ally offers a 12-month CD for 4.15%, whereas a 1-year treasury is currently going for 4.7%. So that difference of 0.55% is pretty much Ally's profit, because they're basically going to take your money and they're going to use it to buy treasuries. So this is probably the most favorable way to set up a bond strategy if you are interested in that. Again, like I said, talk to your financial advisor about this if you really want more details or you want some more personalized advice when it comes to it. So something important to note is that ETFs and the actual bonds and buying the actual bonds themselves, their resale value fluctuates based on market conditions. When yields rise on newly issued treasuries, the value of older treasuries, if they're lower than the newer treasuries, tend to fall, because think about it like this. If you have both 10-year treasuries that are maturing at basically the same exact date, and one gives you a 3.5% yield and another one gives you a 4% yield, which one are you going to value more? You're probably going to value the one that has 4% much more than you would the one that has 3.5%. And this does create a problem with the market value of these securities, because if you were to want to sell them in between the time that they you bought them and the time they matured, you may end up taking a loss if it does lose value in that time frame. So this isn't really that big of a concern if you are planning to hold the bond until maturity. But if you do sell beforehand, there is a chance that you may lose some of your principal. So that is just something to keep in mind. But also remember that the actual face value of the bond, so if it's a U.S. Treasury bond, it's usually $1,000. And that's the value that's used to determine how much in interest you're going to get every year. And then another important thing to consider when it comes to CDs is that they do charge you a penalty if you withdraw from them early. But the nice thing about CDs as well is that their value doesn't fluctuate the same way that ETFs are, that bond ETFs or actual bonds themselves values can. So why has bond investing become so popular recently? Well, since the beginning of 2022, the Fed has been on the most aggressive rate hike cycle in history in efforts to fight off ever-growing inflation. And the Fed fund rate has risen from near zero at the start of 2022 all the way to 4.5% in December of the same year. With the Fed and market pricing the possibility of more rate hikes in the beginning of next year as well. And all of these rate hikes caused the cost of borrowing money to increase to the highest levels we've seen since 2007. And these rate hikes don't only affect U.S. government bonds, but they also affect U.S. corporation bonds and municipal bonds as well. And now the market believes that the Fed will stop raising rates soon. And we've started to see rates on bonds start to fall in anticipation of this change in Fed policy. So many people are looking at right now as being the best time to buy bonds if you wanted to hold them for the long term. Now, the question at hand is, should you buy bonds now? And again, like I said, I'm not your financial advisor, so I highly encourage you to talk to one that understands your situation and your personality and your investment goals. So really, I believe that there's two type of investors. There's the investors that are trying to build their wealth, and then there's the investors that are trying to live off their wealth. When it comes to investors that are trying to live off their wealth, I think that right now buying bonds may be a good ideal for you depending on where you're at financially. I think that it could be a good addition to your portfolio if you are seeking income. This is something, again, like I said, you should talk to your financial advisor about to see if it is appropriate for your situation. Now, when it comes to people who are trying to build their wealth, in my personal opinion, I do not think that buying bonds is a very smart move right now. It's probably one of the most inefficient ways to build wealth because generally speaking, the interest that you get from bonds, you usually have to pay taxes on them. And if you're in a state that has really high tax rates, you might end up losing a significant chunk of your return, mostly just due to those high tax rates. And there also is the opportunity cost of you not being invested in assets that are more growth oriented. For example, like stocks. In my opinion, if you're going to retire soon or you are retired, bonds might be a good option for you. But if you're someone who's still trying to build their wealth, I don't necessarily think that this is the best thing to do. And honestly, in my opinion, doesn't really make sense for you to both try build your wealth and live off your wealth at the same time. You kind of need to delineate the two objectives. And then I will say this, that there is a third type of person as well. And these are people who want to speculate on yields falling. Like I said earlier, when yields fall, the price of bonds go up. So if you are a little bit more speculative, this might be a good time to actually buy bonds with the hopes that the yields will come down and that the price will rise, and then maybe sell them in the future. And in my opinion, in that kind of situation, buying with ETF would make the most sense. So that's all I got for you guys. Thank you so much. If you got any value from this video, I please encourage you to hit the subscribe button and notification bell. And also for you to hit the like button as well. And I'll see you next video. Peace.